folks. Rick Wedell here. Thought we would come to you with some answers on two of the questions that I get asked most frequently. First question that I get asked most frequently is whether or not I actually wear a fleece vest and a button-down shirt every day of my life. The answer is yes. It is super comfortable. I hope that everybody tries it at least once. The second question that I get most frequently is about market timing. This notion that with some sort of perfect knowledge, that we can try and sell out of the market when bad news happens or before bad news happens, and buy into the market, before good news, once the bad news is over or before good news hits. And there are a lot of people that want to believe that strategy works. I, as you know, if you've watched me before, am not a market timer. And so I'm going to come to you with a couple of reasons as to why I don't really pursue that personally or with any of the strategies that we employ here at RFG. For you to get market timing right, you need to be able to do three things, okay? You need to first be able to predict the event, right? So you need to know what it is that you're worried about, is going to happen. The second thing that you need to be able to predict is the timing of that event, both when it starts and when it ends. And the third thing that you have to be able to predict is the market reaction to whatever the event is that you're looking for. And we're going to deal with each one of those in turn. So first, predicting the event itself. There are a lot of things that drive markets that are entirely unpredictable. So I look back to our most recent market correction, which was driven by COVID-19. There were not a whole lot of people in January and February of 2020 that were expecting a global pandemic of the scale that we saw, the amount of lockdowns, the amount of economic disruptions. And that's not just that particular cycle. We saw that with the European debt crisis. We saw that with the U.S. debt downgrade back in the day. We've seen that with a number of events that have driven the markets over time. They tend to be one-off exogenous events that kind of surprise people. When the market gets surprised, it tends to move dramatically, either up or down. But to make that happen, it normally needs to be a surprise. And while there are certainly some people with anything that, can look back and point and say, oh, wow, I predicted that might have happened, they're typically not in the majority. They're typically a very small minority that then tend to get glorified after the fact by, quote unquote, having the right call. The question that I always ask of myself as I look at those individuals is, does that individual have a track record of consistently making the right surprising call, or did they happen to just get one in particular right? The answer normally is the latter, not the former. The other thing that I would say about market timing and just bring up here is that, most people, when they think about market timing, want to put all their eggs in one basket about predicting that event. And the problem is that if you're wrong on one of those bets, one direction or another, the results can be quite dramatic, which is something we'll talk about kind of at the end. Second thing, so you got to be able to predict the event. What is it that is actually going to happen? The second thing that you got to do is you got to be able to predict the timing of that event. And here's why that's important. I always, if you've heard me speak live, you've probably heard me give the example of the tech bubble. So back in 2001, we saw the dot-com bubble explode and the market's correct. And, I'll steal a little bit of my own thunder the next time you see me speak. I always refer to the story of Alan Greenspan as famous for having called that the markets were overheated. He used the phrase irrationally exuberant in testimony before Congress when asked about, how the markets were behaving, which is sort of Fed speak. It's economist speak for, hey, this party's getting a little out of hand here, and maybe we should dial things back a little bit. Everybody remembers him for making that call. Not many people remember when he actually made the call, which was in late 1996. So he wasn't wrong. He was just wrong on the timing of when that problem would actually get corrected. So if you look at the market return from the date he gave his speech to the bottom of the crash, the market actually gained about 30% over that time frame. So just to reiterate, you can still be right on whatever the event is, but if you miss the timing by a number of years, or it takes a couple of, 2, 3, 4 years for that event to develop, then you can still be wrong with respect to your investment decision. And it starts to get a little difficult, because if you sold out in 96 and you've watched the market run up in 97 and 98 and 99, you may be tempted to convince yourself that you weren't right in the first place and jump back into the market at exactly the wrong time again. So it creates a real problem with timing around these events as you start to think about trying to get out and get back in. And I would say, for those of you who are sitting behind the video screen right now and are thinking about, all of the debt that the U.S. has created, and does that create a problem for the United States on a go-forward basis? When will we have to reckon with, the trillions of dollars that we've borrowed, and what does that look like for future budgetary periods? The answer that I would give you is very similar to the dot-com bubble answer, which is, you're not wrong in the sense that at some point we will need to make some changes to our fiscal policy in order to address the interest burden of the debt that we've created. We don't have to pay it off at any point for reasons that are beyond the scope of this video. However, when and if that creates a fiscal pinch is largely undetermined. We don't know if that's a year out, if that's 2 years out, if that's 5 years out, or if that's 10 years out. And so very similar to the dot-com bubble, thinking about jumping out of the market or changing your investment positioning right now to address that concern is one where we fall prey to the trying to predict the timing of a bad market event, of a potentially bad market event, can be very problematic. Last but not least, we have trying to predict the reaction of the marketplace to whatever it is that you're trying to time. And I'm going to use the following exercise. Okay, so let's all just put on our way back glasses for a few seconds and pretend like we're all sitting on January 1st of 2020, and I come to you as your chief investment officer and say, hello, I'm going to tell you that all of the following things are true with perfect foresight. So everything I say to you right now will happen during the course of 2020. We are going to have a global pandemic. You are going to be locked in your house for 2 to 3 months. We still will not be out of that global pandemic by the end of the year. We are going to witness the fastest drop in equity markets since the 1920s. Really, I think since ever. The markets are going to drop 30 to 35% in a 30-day period. We are going to witness the fastest contraction in U.S. GDP since the 1920s. We're going to see the second quarter GDP is going to contract. Economic activity is going to contract by a third, which is fully unprecedented. We are going to see unemployment spike to north of 10%, and unemployment rate at the end of the year is still going to be double where it is today, roughly. And for all of you political pundits out there, the Democrats are going to sweep the November elections. They will have control of the Senate, the House of Representatives, and the presidency by the end of the year. All of those things that I just said are true, and I now come to you on January 1st and say, okay, so what do you want to do with your portfolio today? Do you want to, you can make this choice for the rest of the year. Do you want to be fully invested, or do you want to be out of the market? And most of you at this point would look at me and say, that sounds terrifying. I will be taking my money out of the market and buying, firearms and canned goods and looking for, a cave to go hide in for the next 12 months. Please wake me up when this is over. And the reality is that you would have failed the third test, which is the reaction of the market to whatever event it was that we were trying to time. If you took your money out at the beginning of 2020, you missed a 16% rally in the S&P 500. which is one of the better years that we've had for the S&P on record. So once again, even if you know exactly what's going to happen and exactly when it's going to happen, predicting how the market's going to react to it can frequently be very difficult. The last thing that I will say that's very difficult about market timing is that it is frequently presented as an all or nothing exercise, right? So I either want to be in the market or I want to be out of the market. If I think something's bad is going to happen, I want to be totally out. And if I think something's good is going to happen, I want to be totally in. And the problem with that is that in any point in time in this industry, even the best of us are right only about 60 to 65% of the time. There are just too many variables out there to consider for any one of us to be right, 70, 80, 90% of the time. And so when you take a bet like that and you make it with the entirety of your portfolio, you're effectively giving yourself somewhere between even if you're really, really good, you're still giving yourself about a 35 to 40% chance that you're going to be wrong. And the problem is that when you're wrong, you're frequently catastrophically wrong. You permanently damage your return profile. I'll give you an example of a client who I was unable to dissuade from removing all of their money from the market just prior to the election. And if you look at the 15-day period from October 30th, basically, until the middle of November, the S&P 500 was up about 11% during that time frame. It was only up about 16% for the year. And so just by missing those 2 weeks, because that individual was scared about what the election looked like, the client basically destroyed about 2/3 of their return for that given year. And that's a return opportunity that you don't really get back. So long story short, market timing is not something that we advocate here. We're much more slow and steady, stick to your guns, pick an investment allocation and stick to it. And I'm always happy to speak on this topic because I really do feel very, very passionately about it. You may get lucky. However, you equally may not get lucky. And if you don't get lucky, the damage that you do to your overall portfolio tends to be quite severe. So with that, as always, if you ever have any questions, please feel free to reach out to either myself or your advisor. Hope you have a great day and look forward to talking to you again soon.